Hey guys, and welcome back. I'm Roy Spencer, and we're here with another part of Roy's Investments. This is some sort of a smaller part of it where we detail off how to identify good stocks. We talk a lot about it on the podcast, but I want to give you guys an inside look on how we do it when we're looking at our stuff. When we're looking at it, we want to distinguish between two things. We got the options trades, and then we got investing as well. They're two different things. Options trades are shorter term. We're looking at the companies to see if that they're good in the short term. And what we're trying to see there is we're looking for that they're not super established, but they have a bright future or they're part of future innovation. What do I mean by that? I mean that the company is something that is developing technology for the future. And a company I always bounce back to is a company like Workhorse. Workhorse is an autonomous EV delivery company. And I like that a lot because good they've got good like their idea in a sense is what they're trying to do is a very good idea, but the problem with they're having it is like they don't have a lot of cash. They're running into debt problems, and that makes their company very volatile. There's people are undecided if this is a good company. They have goods and then they have bads, and that makes their company very volatile, which is kind of what we're looking for in terms of what we're doing in terms of trading options. So when we're starting off, we're looking for a volatile company, which Workhorse meets that demographics. And then when we're looking at that, we want to find a company where like the puts are very volatile as well. So if the company is volatile, the puts are going to be volatile. So when we looked into it, we see that like we were able to understand the ROI before the trade happens. But as I want to identify with you guys, like just because it has a good ROI potential for like the put does not mean that we want to bet on it. And the reason because these companies are very volatile because there's a lot of bets that will go down, and these people do a lot of homework. They come up with good ideas, and sometimes they have like a good idea that the company is going to go down, and for because like the company ends up actually going down at the end. So just because it's got like a high volatility does not mean we want to jump right in. We want to identify where its local mins are and like local maxes are. And we want to see that when we're trading puts, like it's going to be greater when the volatility has jumped up, which means that the company is usually like selling off. That increases the volatility for the put options. And so we want to find that it's sold off, but we've seen it like kind of level out to a point. And we want to believe that that's like a final bottoming out. So if we see that it's traded into that like kind of like threshold for a while, then maybe we'd want to start into a put on it. Puts are betting that the stock won't go below a certain point, which is good because if you've identified a local minimum, then you're able to just kind of trend along that local minimum and try to like work with the stock if it like starts to increase back up. We're in a sense we're looking for a company that's going to be not blowing up to the upside because that's where we want to buy calls, but we want to find a company that's going to stay like around the same level or go up slightly. Now I mentioned buying calls. We're looking to buy calls, or at least how I do it is I'm looking to buy calls on companies that are going to explode, like AMC. Like if you guys have been following stocks at all, you've seen that like AMC recently blew up, took up to the offside, and like in about a month or maybe a few weeks ago, but like they've had days where they've been up over like 60%, 70%. And when they're up over 60 or 70%, then the calls on that are up over thousands of percent. And that's why we want to be in on that instead of just trading it. These options trades are able to capture the short-term movements of it and use that to our advantage. But they're way more risky than investing in a long-term solution in a company. So what we're looking for in terms of buying calls, we're looking for, our earnings nearby. This is a potential chance for the company to release a new product. Is there hype around the stock? Is the stock about to blow up to the upside because, we're seeing it reach a local max and there's a lot of hype around it. So, there's a chance that it breaks out above its local max. These are all things that we want to look for, but there's a chance that when we're trading it, it falls within like a trading range. And if we're seeing it about to pop above like a certain level, like up here, it could just be bouncing back on it and then going back to the downside and then trading within that range. So we want to make sure that it's not going to just do that. So we trade calls and buy calls on a very, very limited basis. And we don't go all in on calls. We stay a little bit reserved when we do it because like they have a very big chance that they can backfire and the time works against you in these. But these are all short term. When we look at investing, however, we want to see that it's a different game. It's not exactly like short-term trading. Short-term trading is all about movement. It's about hype. It's about like trade wins. For these, investing is by definition a long-term trade, which means that you're holding it for more than a year. So what you need to do when you're looking at something for this is companies over time realize their true value and the company's stock price trades towards that. So the company's true price is realized by true things about it, like fundamentals and statistics. So you might be asking yourself, like, well, we've never really covered this. It's okay. Where we find something like that is on their 10K. And the 10K is this massive long article. It's over 100 pages, but there are a few things that you should check out within it. You should look at kind of like their plans for growth, which is research and development. You should look at the success of like the C-suite members and if they've been a part of like any teams, and also like the incentives from outside companies that have vested interest in it, because that would show like who's invested in it and what they think about it. If you see a bigger name on it, like Goldman Sachs has like a giant allocation into a company, it usually means that these are pretty safe bets, and that would be something that I would want to hedge off into like a longer term investment. But when you go into these things, maybe you don't want to read the entire 10K from a company. So you go to Yahoo Finance instead. That's more of a shorter, quicker thing, and you're able to see some quick stats on it. What do you want to look at when you're in there, though? You want to see that it's growing. You want to see that this company has poised for the future. You don't want this company that's just sticking around. Like, I would never invest in something like Coca-Cola because that's boring. Like, that might stick around. I'm not sure. But what the heck are they going to do for a new product? I want like my longer term companies are something like Apple. They got company plans for the future. They've got a bunch of customers. They have a loyal brand of customers, and then they also have growth for like the future. They have like when I went into their 10K, I saw that they had plenty of plans for research and development. They actively spend money on research and development, and you can see that in the 10K. And then you're able to kind of like verify what they're doing. But let's say you're in Yahoo Finance and you didn't want to do all that deep digging. Let's face it, that takes a lot of work. Well, I'd start off by looking at something like how much cash do they have? Do they have more cash than their total debt? This is important because they need to be able to pay their bills, much like a person. If they have cash on hand and they can pay their bills, then the company or the banks are more willing to give them more money. And this is good. And that's when I would want to give them more money as well. So you want to see that they have the cash able to pay off their bills. But just because they don't have that, and they might have money tied up other places, doesn't mean that you should just say screw it to them. Like, you want to go in there and you want to see at that point, like if you still believe in the company, you want to see that like, maybe there's a chance that they're growing and they've invested money into stuff and they have plans for future endeavors. So they have their money tied up and stuff, then that's okay. Or that can be okay, but you want to make sure that they're not doing too much of that. And that's where you'd want to look at something like the current ratio, because that measures like how well they're paying off their bills. Current ratio is a measurement of assets to liabilities in a sense. You want to make sure that they have more assets than they do liabilities so that they're able to pay off stuff. So when you're looking at it, something where it's like above 1, or around 1, that's pretty good. But, if it's around 5 or 6, you might start wondering like, okay, well, they're not doing enough with their money, which is a true thing. Or, if you look and you see that it's too low, you might think that you're like, all right, these guys have no chance of paying off their bills. And you don't want that either. So you want to find something kind of in the middle, and you want something with like a good plan for growth. And you want to see that they're moving their money into like looking for like new developments and new like technologies, unless their plan is to grow within the market. But these are all things that I would start off by doing, but I wouldn't just say that that's the only thing I'd check out. But you should start with these, and then you should work your way in if you get interested in a company based off of what you find from these. Thank you so much for joining me today, and hope you enjoyed the video.